Hey there, crypto cowboys and digital dollar divas, let's talk taxes. Yeah, I know, about as exciting as watching paint dry, right? But here's the thing, the IRS wants their cut from your crypto gains. And trust me, they're not afraid to use a magnifying glass and a pair of tweezers to get it. Think you can just slip under the radar? Think again. The tax man is getting savvier by the day. They're onto our crypto shenanigans. That's why understanding crypto taxes isn't just a good idea, it's essential. Ignoring crypto taxes is like playing a high-stakes poker game with your eyes closed. You might get lucky for a hand or two, but eventually, the house always wins. And in this case, the house wears a very serious Uncle Sam hat. So, buckle up, Buttercup. We're about to dive into the wild world of crypto taxes. By the end of this, you'll be filing like a pro and keeping more of your hard-earned digital dough. Alright folks, let's break down exactly when Uncle Sam decides your crypto needs a little trim. It's not rocket science, but it's not as simple as buying and holding either. First off, selling your crypto for a profit, that's a big, fat, taxable event. You made money, Uncle Sam wants his share, pretty straightforward. But here's the kicker. Trading one cryptocurrency for another? Yep, also taxable. Even if you're just swapping Bitcoin for Ethereum, the IRS sees that as selling one asset and buying another. And don't even get me started on using crypto to buy stuff. That pizza you bought with Bitcoin back in 2013? Taxable event. That coffee you paid for with Ethereum last week? You guessed it. Taxable. Essentially, anytime you dispose of your crypto, whether you're selling, trading, or using it to buy goods and services, the IRS wants to know about it. Hold on to your hats, crypto comrades, because there's a new sheriff in town. The 1099 DA form. This bad boy is set to shake things up in the 2025 tax season, and let me tell you, it's bringing some serious reporting requirements with it. Think of the 1099 DA as the IRS's way of keeping closer tabs on your crypto activities. It's like having a little digital taxman perched on your shoulder, watching your every crypto move. Now the details are still being ironed out, but one thing's for sure. This form is going to make it even harder to fly under the radar. The IRS will be getting more detailed information than ever before, so accurate reporting is going to be crucial. Alright, let's talk about the 1099 forms you might see in 2024. Think of them as love letters from the IRS, reminding you that they know you're out there, making crypto moves. First up, we've got the 1099B. This one comes from your crypto exchanges and reports your gains and losses from trading. It's like a report card for your crypto trading skills, except failing grades could mean an audit. Then there's the 1099 MISC. This one covers any income you've earned from crypto, like staking rewards or airdrops. Free money, not in the eyes of the IRS. They want their cut. And finally, there's the 1099K. This one's for all you crypto hustlers out there who are using digital currencies for business transactions. If you've received more than $600 in crypto payments, expect a 1099K to land in your inbox. The key takeaway here is this: don't ignore these forms. They're not just junk mail, they contain crucial information that you need to file your taxes correctly. Section 5, Crypto Tax Horror Stories. Don't be that guy. Let's take a break from the technical stuff and dive into some real-life crypto tax horror stories. These tales are not just cautionary, they are a stark reminder of what can go wrong if you don't take your crypto taxes seriously. Because nothing says pay attention like a cautionary tale, right? These stories are more than just anecdotes, they are lessons learned the hard way. Take for instance the unfortunate soul who decided to dabble in day trading. He thought he could outsmart the market and make a quick buck. He was buying and selling like a madman, racking up hundreds of transactions. Sounds great, right? The thrill of the trade, the adrenaline rush, it was all very exciting. Except he didn't keep track of any of it. No records, no logs, nothing to show for his frantic trading activity. No spreadsheets, no software, nothing. He was flying blind, thinking he could sort it all out later. Come tax time, he was facing a mountain of paperwork and no idea where to start. The IRS wasn't amused. They don't take kindly to disorganized traders. He ended up owing a hefty sum in back taxes plus penalties and interest. Ouch! The financial hit was devastating and it took him years to recover. Then there's the story of the crypto enthusiast who struck gold during the 2021 bull run. He thought he was on top of the world. He cashed out a big chunk of his Bitcoin, bought himself a fancy car, and lived the high life. It was a dream come true, or so he thought. Only problem was, he forgot to set aside money for taxes. In his excitement, he overlooked the tax implications of his windfall. When tax season rolled around, he was hit with a tax bill he couldn't afford. The IRS doesn't care about your spending spree, they want their cut. He ended up having to sell his beloved car at a loss just to pay Uncle Sam. The dream quickly turned into a nightmare. Talk about a crypto hangover. The regret was palpable and the lesson was learned the hard way. These are just a couple of examples of what can happen when you don't take crypto taxes seriously. The consequences can be severe and long-lasting. Don't let this be you. Be proactive, stay organized, and keep meticulous records of all your transactions. Learn from the mistakes of others and stay on the right side of the IRS. Your future self will thank you for it. Section 6. Staying right with the IRS tips and tricks for accurate reporting. Alright, enough with the scary stories. Let's talk about how to stay on the IRS's good side. Because trust me, you want them on your good side. First and foremost, track your cost basis. This is crucial. Your cost basis is basically what you paid for your crypto, and it's essential for calculating your capital gains or losses. Next up, consider using crypto tax software. These handy tools can connect to your exchanges, track your transactions, and even generate your tax forms for you. It's like having a personal crypto accountant at your fingertips. And of course, don't be afraid to seek professional help. If you're feeling overwhelmed or unsure about anything, a qualified crypto tax advisor can provide personalized guidance and ensure you're filing correctly. Remember, filing your crypto taxes accurately isn't just about avoiding penalties, although that's a nice bonus. It's about being a responsible member of the crypto community and contributing your fair share. Section 7. Tax time savings, why setting aside money matters. Let's talk about everyone's favorite subject, money. Specifically, setting aside money for taxes. I know, it's about as fun as a root canal. But trust me, it's way less painful than getting slapped with a massive tax bill you weren't prepared for. Here's the thing, when you sell crypto for a profit, you're going to owe taxes on those gains. And those taxes are due when you file your tax return, not when you feel like paying them. This means that if you don't plan ahead, you could find yourself in a tight spot come tax season. Imagine the stress of opening your tax bill and realizing you owe thousands of dollars that you haven't set aside. It's a nightmare scenario that can be easily avoided with a bit of foresight and planning. So what's the best way to avoid a tax time meltdown? Set aside a portion of your crypto profits throughout the year. A good rule of thumb is to set aside around 25 to 30% of your gains, just to be safe. This way, when tax season rolls around, you'll have the funds ready and waiting. Think of it like paying yourself first, but instead of going towards your dream vacation or a new gadget, it's going towards Uncle Sam. It might not be the most exciting way to use your money, but it's definitely one of the smartest. By setting aside money regularly, you can avoid the last-minute scramble to come up with the cash. This not only reduces stress but also helps you stay on top of your financial game. Plus, having a dedicated tax savings account can make the process even smoother. You can set up automatic transfers to this account every time you make a profit, ensuring that you're always prepared. Remember, the goal is to make tax season as painless as possible. By planning ahead and setting aside money throughout the year, you can avoid the stress and enjoy the peace of mind that comes with being financially prepared. So, start today. Take a look at your crypto profits and set aside a portion for taxes. It might not be the most thrilling task, but your future self will thank you. Exciting, right? But hey, at least you won't be scrambling to come up with the money when tax season rolls around. And that, my friends, is why setting aside money matters. Section 8. The future of crypto taxes. Stay informed, stay compliant. Well folks, we've reached the end of our crypto tax adventure. It's been quite a journey, hasn't it? From understanding the basics of crypto transactions to diving deep into the nuances of tax regulations, we've covered a lot of ground. Congratulations on making it this far. Your dedication to understanding crypto taxes is commendable. You've earned yourself a digital high five, and hopefully a newfound appreciation for the importance of crypto tax compliance. It's not just about avoiding penalties, it's about being a responsible participant in the crypto ecosystem. But here's the thing, the world of crypto is constantly evolving, and tax laws are always playing catch-up. New regulations can emerge overnight, and what was true yesterday might not hold tomorrow. What's true today might not be true tomorrow. This dynamic nature makes it essential to stay updated. That's why it's crucial to stay informed about the latest developments in crypto tax regulations. Subscribe to industry newsletters, read up on the latest news, and keep an eye on official announcements. Follow crypto tax experts on social media, join online forums, and participate in webinars. These platforms can provide real-time updates and expert insights. And don't be afraid to reach out to a professional if you have any questions. A financial advisor or tax professional can offer personalized advice tailored to your specific situation. The crypto space is full of opportunities, but it's also full of potential pitfalls. Being well-informed can help you navigate these challenges effectively. By staying informed and compliant, you can navigate the complex world of crypto taxes with confidence and keep more of your hard-earned digital assets. Knowledge is power, and in this case, it can also be a financial safeguard. So go forth, crypto crusaders, and spread the gospel of crypto tax compliance. Share your knowledge with others and help build a community of informed and responsible crypto enthusiasts. And remember, when in doubt, consult a professional. It's always better to seek expert advice than to make costly mistakes, because in the world of crypto taxes, it's always better to be safe than sorry. Stay vigilant, stay informed, and stay compliant. Your future self will thank you.